Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Byd Company Limited annual report. Byd Company Limited offers a diverse range of businesses and services across various sectors. In the mobile phone industry, the company provides mobile handset components such as housings and electronic components, as well as assembly services. In addition to its mobile phone business, BYD also operates in the automobile sector. The company manufactures and sells automobiles, auto-related molds and components, and offers leasing and after-sales services for vehicles. Furthermore, BYD is involved in rail transport and related businesses, providing a comprehensive range of transportation solutions. The company's product portfolio extends beyond automotive and transportation to include power batteries, lithium-ion batteries, photovoltaic products, and iron battery products. These offerings cater to various industries and applications, solidifying BYD's position as a multifaceted business entity. Byd Company Limited market capitalization of $971 billion is significantly larger than the average industry peer of roughly $33 billion. This shows that Byd Company Limited holds a significant advantage in their industry. Byd Company Limited trades at a higher price-to-earnings ratio of 67 times and a higher price-to-book ratio of 4.03 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified by examining the key points related to revenue growth and decline. On the growth side, mobile handset sales, automobiles and components sales, and overseas operations have been significant contributors to revenue growth. In particular, the increase in revenue from principal operations by 24.3% is a notable achievement. In contrast, joint ventures and associates have experienced declines in sales, with decreases of 55.8% and 8.3%, respectively. Non-operating income, other income, investment income, and revenue from contracts with customers have also contributed to the decline in revenue. The growth rates for operating revenue have been positive in some years, but negative in others, indicating volatility in revenue performance. The breakdown by region shows that overseas operations have grown significantly, while PRC operations have declined slightly. By product/service, mobile handset and automobiles and related products revenues have increased substantially, while adjustments and eliminations have decreased. Overall, the drivers of revenue growth or decline are complex and multifaceted, reflecting a range of factors including market trends, operational performance, and external influences. The net income and profit margins of the company underwent significant changes between 2021 and 2025. Net income decreased by as much as 23.1% in some years, with an average decline of around 10%. Profit margins also suffered, decreasing by 4.2 percentage points from 5.2% to 1% over the same period. The reasons for these changes are multifaceted. One major contributor was the increase in operating costs, which outweighed decreases in tax and surcharge expenses and other income. Additionally, selling and research and development expenses rose due to increased marketing efforts and investments in new technologies. However, finance expenses decreased as interest income exceeded interest expenses. The decline in gross profit margin can be attributed primarily to changes in the company's product structure. This shift had a ripple effect on net income and overall profitability, contributing to the observed decreases. Overall, these changes reflect the company's evolving business landscape and its efforts to adapt to changing market conditions. The company is generating positive operating cash flow. According to various summaries, the net cash flow from operating activities for both 2024 and 2025 is consistently reported as positive. The exact figures may differ slightly across different pages, with RM 133,454 million in 2024 and RM B 59,136 million in 2025 being mentioned on page 58. However, all other summaries also confirm the company's ability to generate positive operating cash flow, indicating a stable financial performance. The company's performance varied across different segments. One segment that stood out was the mobile handset components, assembly, and other products segment, which showed strong results. On the other hand, the automobiles and related products and other products segment struggled, indicating a decline in sales or revenue. In terms of regions, there is no specific information provided on which ones performed well or poorly. However, it is clear that certain segments within the company experienced difficulties, while others remained resilient. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. On page 17, it is stated that the company distributed cash dividends for every 10 shares in 2024, indicating a commitment to returning value to its investors. This was further reinforced on page 27, where it is mentioned that a cash dividend of RMB 39.74 per 10 shares, including tax, was distributed to all shareholders. In addition to dividend payments, the company has also engaged in share buybacks. According to page 276, the company did participate in a partial redemption of GUOTONG trust bonds through share buybacks. This suggests that the company is proactive in managing its capital structure and returning value to its shareholders through various means. Overall, it is clear that the company has a track record of paying dividends and buying back shares, demonstrating its commitment to shareholder value creation. Concerns about inventory buildup and supply chain disruption. The company's financial reports reveal a growing concern regarding inventory buildup and potential supply chain disruptions. One key indicator is the increase in inventory turnover period, which rose from 61 days in 2024 to 72 days in 2025. This prolonged shipping cycle can lead to delayed delivery of goods and affect customer satisfaction. Furthermore, the company's raw materials and finished goods inventories have seen significant increases. Raw materials inventory grew by 20.35%, while finished goods inventory increased by a substantial 48.53%. These rising inventory levels may indicate inefficiencies in the supply chain or overproduction, which can lead to financial losses if not managed properly. The impairment rates for raw materials and finished goods also suggest that some of these inventories are becoming obsolete or unsellable. The impairment rates for 2025 were higher than those in 2024, indicating a potential issue with inventory management. Additionally, the provision for inventory impairment increased by RMB 2,475,788, which is a significant amount. These concerns highlight the need for the company to reassess its supply chain and inventory management strategies to prevent further buildup and disruptions. By addressing these issues, the company can minimize losses and maintain a competitive edge in the market. That concludes the financial summary for Byd Company Limited. Feel free to comment below, and I will be happy to answer them when possible.